Hello and welcome to this week's strategy video with me, David Jones, and Trading 212. Now, there have been quite a few requests for what we're going to cover this week, and we're doing the subject of Fibonacci retracements. Now, I have to start off by saying I am not a big fan of Fibonacci retracements. I don't believe they work, but what do I know? So what we're going to do, we'll go through the theory and look at it in a real market, and you can make up your own mind. So Mr. Fibonacci was an 11th century mathematician, came up with the Fibonacci sequence, which we'll see in a second. And the argument that the Fibonacci fans would use is that you see these Fibonacci numbers occur everywhere in nature. For example, the shape of the galaxy is a Fibonacci logarithmic spiral. It's the same for the shape of a snail's shell. You can figure out the number of petals on a flower and how branches grow. It's all determined by Fibonacci. So the argument is, well, Fibonacci occurs everywhere in nature. There's no reason why we can't apply it to the market. So I'll let you make up your own mind, but first of all, let's take a look at the theory behind Fibonacci retracements. So Mr. Fibonacci, our 11th century mathematician, came up with the Fibonacci series of numbers. So here we go. 1, 1, then 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, 5 plus 3 is 8, 8 plus 5, 13, 13 and 8, 21, 21 and 13, 34, and so it goes on. So we have our Fibonacci sequence of numbers where every number in the series is the previous two added together. So these numbers then have certain properties. For example, once we get past 1 at the beginning, any number divided by the next number along, the result tends towards, gets closer and closer to 0.618. Any number divided by the number 2 along, let's say 8 divided by 21 in this example, the number gets the result, gets closer to 0.382. Then any number, let's take 8 divided by the number 3 along, the result will get closer and closer to 0.236. So these are some of the values of the Fibonacci numbers. Then right at the beginning we have 1 divided by 2, the result is clearly 0.5. So we have these various calculations that come from Fibonacci numbers, and what chartists do is convert these to percentages. So 23.6 becomes, or 23.236 becomes 23.6%. Then we have 50%, 38.2%, and 61.8%. Okay, so those, for a charting point of view, these are important Fibonacci retracements. So let's see how this actually works. Let's look at the theory. So I'm going to clear the screen and we'll start with a theoretical market. So I've written the numbers down here as a reminder. So let's say a market is moving higher. It's doing this and then starts selling off. Fans of Fibonacci will use Fibonacci retracements to try and figure out how far back is this market going to fall before it resumes its trend. So they'll say they might take the move from here to here. So let's say that is, I don't know, 100 points moved. So the market rallied 100 points. When the markets drop back 23.6% of that move, that's the first Fibonacci retracement level. So they'll look to see if the market holds there. If the market breaks, the next level they'll look at is 38.2%. If it breaks that level, they'll look to see if the market holds at the 50% level when it's dropped back 50% of that rise. And the final Fibonacci level for this example is 61.8%. So they'll wait to see what the market does at these levels. And the assumption is they're going to be like hidden levels of support in an uptrend or hidden levels of resistance in a downtrend. And the thinking is if the market drops back more than 61.8% of the prior move, it's going to go all the way back to where the move started. Okay, hopefully you're still awake after that explanation. Now what we'll do, we'll apply it to a real market and we're going to take a look at Fibonacci retracements on the price of gold. So let's take a look at Fibonacci in the real world. What we're looking at is gold. So I'm going to do a couple of historical examples to show how it might have worked, and then a current example on gold. So Let's pretend it's the end of February, so we're here. We've watched gold go from these December lows around about $1,120 an ounce, up as high as here, up as high as sort of 1260 area recently. And it starts to come off. So we think, right, I'm going to use my Fibonacci retracements to try and figure out where the price of gold might stop sliding and bounce and continue this trend. So let's put the retracements on. So we pick them up from here. We start at the beginning of the move. So I click down there and then drag it all the way up to the high. And it puts the retracements on for me. Let me just adjust this one down here. There we go, that's better. Like a lot of software, it does include some additional Fibonacci levels, but the main ones I'm worried about, let me just make this a bit clearer. I'll right click, change the color, make the lines a bit thicker. Here we go. So what I'm looking at is the 23.6, the 38.2, the 50, and the 61.8. So if the Fibonacci is going to work, the market's gone up, and then we're looking to see if these levels, the 23.6, the 38.2, the 50, and the 61.8, do they support the market? Let's just walk through and see what happens next. So these are daily candles, don't forget. So the market's selling off. So we're on the 23.6 level now. That's broken, it's gone through that. So the next one to watch for support is the 38.2 at 12.09. That's gone again. We can see it breaking through. And the next level we're looking at is 50%. So the market's gone from here up to there. And now if it gets to this level, it's dropped back 50%. That's our next Fibonacci level. So let's just push it forward. And actually, it looks like it's working. So the market went from X to Y, dropped back 50%, and the market has recovered. Let's have a look at the next rise. What happened next after this? The market did push higher up to here, just back up near that old high and started coming off again. So again, as usual, let's just adjust our lines. So we'll pick it off that high there. And again, we're just trying to see now what happens. Does the market hold on these old levels? I think it's pushed just a little bit higher. So let's just nudge it up to that high up there. There we go. And it started coming off. So our 23.6% level is at 12.54 an ounce on gold. Then we've got 12.28.5. That's our 38% retracement. And then the 50% is there at 12.08. And then the 61.8% is there at 11.87. So let's just walk through and see what happens next. The market's sliding. So it's taking out that 23.6% level. So 38.2, that's the next level to watch. It's taken that out. But so far it's holding, and once again the 50% retracement level has worked. So we took out the first two Fibonacci levels, but the market did move higher again. Okay, so now this is an up-to-date chart for gold up until the end of last week. So the market had pushed higher beginning of June, sold off. Let's put our Fibonacci levels on. Let's take them again. Let's take them again from the start, from down here. So from those lows in December up to the most recent high, beginning of June. Again, I'll right click, make this a different color so we can see it. There we go. So the market slid off, has slid below 23.6. At the moment, it is holding above that 38.2% retracement at 12.30-ish level. And if that level breaks, the 50% one to watch out for is 12.10. So there might be a couple of levels, if you're a fan of Fibonacci, to keep an eye on for gold in the days to come. That's it for this week. As I say, I'm not the biggest fan of Fibonacci, but maybe for you, it will make a difference for your own trading. You can try it out, obviously, on the trading platform and see what you think. We'll be back in a week's time with another trading strategy video. As usual, if you're not subscribed, click the subscribe button up there to make sure you never miss out on any of these videos in the future. If you like the video, just click the thumbs up down below. And if you'd like us to cover anything in the future you think we've missed out, just leave us a message in those comments down below and I'm sure we'll get round to it. But for now, for this week, we'll leave things there and I hope you have a good trading week.